Bitcoin is already warning that liquidity is thinner than the AI headlines suggest. If the dollar stays strong and rates move back into the conversation, even good Korea AI stocks need smaller position sizes. Welcome to Dragon Bullion! The first mistake is to say that the market is simply bullish, because AI remains a long-term theme. AI is still the structural axis, but today's market is not only about the structural axis. It is about liquidity, entry price, and whether investors are still being paid enough to add risk after a strong move. The evidence is not hidden. Bitcoin is weak. The US dollar is firm. Rate cut expectations can be pushed back by strong employment, and Korea has to deal with the Korean won currency at the same time. That combination means investors should stop treating every dip as an automatic opportunity. For US investors, the KOSPI setup is still interesting because Korea sits inside the commodity and AI memory supply chain. Samsung Electronics and SK Hynix remain central. But the condition is different now. You want confirmation from FX, liquidity, and chip volume before chasing. The opposite case is also clear. If Bitcoin keeps falling, the $1 exchange rate keeps pressing higher, and chip leadership starts losing turnover, the market is telling you that risk appetite is narrowing. In that case, cash and smaller entries are not weakness. They are discipline. Bitcoin weakness should be treated as an early liquidity check, not a separate crypto story. When speculative liquidity is healthy, Bitcoin often confirms risk appetite before weaker assets recover. When Bitcoin falls while equity investors are still talking about AI momentum, the message is that broad risk money is becoming selective. There are two possible explanations. One is simple risk reduction across assets. The other is rotation out of crypto and into the hottest AI equity theme. Both explanations still lead to the same risk rule. Crypto market depth is weaker, and late entries in crowded risk assets need tighter sizing. That matters for Korea because the Korean equity bull case needs liquidity. The KOSPI can still be supported by AI semiconductors, platforms, and data center expectations. But the index cannot ignore global risk appetite. If Bitcoin stabilizes and Ethereum stops losing relative strength, the market can repair. If Bitcoin keeps sliding, it is dangerous to call the Korean dip clean. The condition for a phased buy is a stop decline in Bitcoin plus stable chip leadership. The reduced condition is Bitcoin breaking lower while the $1 exchange rate rises and foreign or domestic turnover fades. That is the decision tree. Strong US employment can help the market avoid an immediate recession scare, but it also delays the rate cut story. This is why the same economic data can support prices in the morning and cap valuation in the afternoon. Good employment means the economy is not breaking. It also means the Federal Reserve has less pressure to ease quickly. That is the tricky part for growth stocks and Korea AI exposure. Semiconductor earnings can be strong, Nvidia capex can remain large, and the long-term HBM demand story can stay alive. But if rates move higher or stay high for longer, the market has to discount those future earnings more heavily. The practical implication is not to sell every AI position. It is to separate old low-cost holdings from late chase entries. Old positions can be managed around the profit cycle. New money needs a better entry and a clearer confirmation signal. If employment stays strong while CPI also comes in hot, the risk becomes more serious. Then WTI US yields and the $1 exchange rate should be watched together. If all three pressure points rise at the same time, the market is not giving you a simple buy-to-dip setup. A strong dollar can be relatively helpful for the United States because it reduces some import price pressure. It is different for Korea. A weaker Korean won currency makes imported energy, food, raw materials, and components more expensive in local terms. That can become an inflation problem and a margin problem. This is why the dollar-won exchange rate is not just a currency ticker. It is a pressure line for Korean equities. When the dollar-won exchange rate refuses to calm down, foreign investors have to consider both stock risk and currency risk. Domestic investors also have to think about purchasing power. Samsung Electronics and SK Hynix can still benefit from the AI memory cycle. But currency pressure can limit the multiple investors are willing to pay. A strong company does not cancel the FX discount. It only gives the market a reason to defend the stock if the macro pressure stops getting worse. The buy condition is the dollar-won exchange rate stability plus chip volume. The reduced condition is a higher dollar-won exchange rate, weaker KOSPI breadth, and AI leaders losing trading value. This is why the currency comes before the stock chart today. Korea has a wider AI ecosystem than a simple semiconductor-only story. Taiwan is more concentrated around chip manufacturing. Korea has memory, devices, software, data centers, games, platforms, autos, robotics, and financial infrastructure. That breadth is why global companies can view Korea as an AI deployment base, not only a supplier. That breadth is bullish for the long term, but long-term strategic value does not remove short-term price risk. The report's key point is that Samsung Electronics and SK Hynix remain core assets, while late entries need to be treated differently from existing low-cost positions. For US investors, the right question is not whether Korea AI is interesting. It is whether the market is paying you enough now, with Bitcoin weak, rates uncertain, and the Korean won currency under pressure. The answer may be yes, only after a pullback and confirmation. The risk scenario is a broad AI label rally where semiconductors rest and software or platform names run as the final rotation. That can create trading opportunities, but it can also signal a late-stage liquidity chase. When leadership broadens for the wrong reason, position size matters more than theme confidence. Samsung Electronics and SK Hynix should not be treated as identical trades. SK Hynix is more directly tied to memory operating leverage and HBM demand. Samsung Electronics is broader, with memory, foundry, phones, consumer electronics, and a more complex margin mix. Both can benefit from Nvidia-linked AI capex, but their confirmation signals are not the same. The evidence investors need is practical: memory pricing, HBM demand, Nvidia capex guidance, and trading volume in the Korean leaders. If those signals hold while FX calms, a pullback can be accumulated gradually. If those signals weaken while FX stays pressured, this is not just volatility. It becomes a profit cycle warning. The condition for old positions is different from the condition for new money. Long-term holders with low cost can focus on whether the AI memory profit cycle remains intact. Late buyers should use rebounds to manage size because expected return is already lower after a strong move. The opposite scenario is a market that talks only about AI while volume thins and Bitcoin keeps warning. In that case, even good companies can give bad entries. Respect the difference. The US market can hold up longer than Korea because the dollar system is stronger and mega cap earnings are deeper. A strong dollar can support US purchasing power, and platform companies can defend the index when broad liquidity narrows. But this is sequence, not immunity. If rates rise again, WTI crude oil lifts inflation pressure and crypto keeps weakening. US equities can eventually feel the same liquidity stress. The first pressure may show up in weaker speculative assets, then crowded growth, and only later in the highest quality platforms. For US exposure, the relative preference is not a blind AI basket. It is profitable platforms, software with real demand, and chip-linked names with earnings proof. Nvidia remains the center of the AI capex conversation, but the market needs capex confirmation rather than only enthusiasm. If US megacap platforms hold while Bitcoin stabilizes and WTI stays contained, risk appetite can repair. If platforms start losing leadership after crypto and Korea already weakened, the defensive message becomes stronger. WTI matters because oil turns currency pressure into inflation pressure. For Korea, a weak Korean won currency plus stronger oil is a direct problem. For the United States, WT, I can still challenge the inflation narrative even if the dollar is firm. The market does not need an oil shock to change behavior. It only needs WTI to stop helping the disinflation story. If oil rises while employment is strong, the rate cut timetable gets less comfortable. That affects equity multiples, especially for growth and AI themes where future cash flows carry a higher discount rate sensitivity. The condition is simple. If WTI stays contained, the $1 exchange rate stabilizes, and chip earnings evidence stays strong, the market can absorb volatility. If WTI rises, the $1 exchange rate rises, and Bitcoin falls together. That is a three-part warning. This is why investors should watch the chain rather than one asset. Bitcoin tells you liquidity. The $1 exchange rate tells you Korea stress. WTI and rates tell you whether inflation pressure is returning. The plan is conditional. First, do not chase Korea AI exposure just because the long-term story is good. Second, split old holdings from new money. Third, make the $1 exchange rate and Bitcoin part of the entry checklist, not afterthought. The buy condition is a calmer $1 exchange rate, Samsung Electronics and SK Hynix holding volume, Nvidia-linked AI capex evidence staying intact, Bitcoin stopping its decline, and WTI not reviving inflation pressure. If those pieces line up, phased entries make sense. The reduced condition is the opposite. If Bitcoin keeps falling, the $1 exchange rate pushes higher. CPI or rate talk becomes uncomfortable, and chip leaders lose turnover. Cut risk before looking for the perfect bottom. For crypto, avoid Ethereum or altcoins alone if Bitcoin is still weak. Bitcoin should be the core liquidity check, with Ethereum only as a smaller secondary exposure after risk appetite improves. Here is the market core. AI remains a major structural theme, and Korea remains strategically important in the Nvidia, memory, platform, and data center map. But today's setup is not a green light to chase. Bitcoin weakness, dollar strength, rate uncertainty, and WTI inflation risk are all telling the same story. Liquidity is thinner, expected return is lower. Position size matters more. If the $1 exchange rate stabilizes, Samsung Electronics and SK Hynix hold volume, Nvidia capex evidence remains strong, and Bitcoin stops warning, Korea can be bought gradually on pullbacks. If those signals fail together, defense comes first. Do not confuse a good asset with a good entry. In this market, the edge is to wait until FX earnings and liquidity stop arguing with each other.